Guys, car loans are a little bit like the canary in the coal mine for the economy. It's said that when people are having financial problems, they stop paying their car loans last because they need that car to get to work. So they would rather miss payments on their rent or their mortgage because they won't get evicted right away. But if their car gets taken away or repossessed, they can't get to work and then they can't make money. So that makes things a lot worse. So the latest news is that Americans are having a really hard time paying their car loans and repossession rates are increasing by a lot. So I want to take a look at this story. And in this story, they give an example of somebody who stopped paying his car, got repossessed. But when they talk about the car that it is and how much his loan was and what his interest rate is, you will be shocked. So I'm going to look at that and talk about what he could have done a lot differently to not be in this type of situation. So let's take a look. So this article is saying this is the perfect storm and that more Americans can't afford their car payments than during the peak of the financial crisis. So they say Americans are using ever more debt to fund new car prices. And the Fed revealed a dramatic spike in the new amount of car loans, which increased by more than $2,000 in one quarter from just over 38,000 to 40,000, new record. So if you look at how much people financed on new car loans, looking at right about before the pandemic started around March 2019, that amount financed was about 30,000. Now we are up above $40,000. And so this could be a combination of people have less money to put down on cars, so they're financing more of it. And of course, the price of new cars has skyrocketed because of the shortages. But not only are people borrowing more money, but the interest rate they're paying is almost doubled since the start of 2022, up to 6.67%, and that's the highest in 12 years. So looking at a 60-month auto loan national average rate, we're up here 6.67, where just at the beginning of 2022, we were at like 3.5%. And so this is the highest it's been since around 2010. So you're getting squeezed on both sides. The price of the cars are more, people are taking out bigger loans for these cars, and the interest rate that they're paying is now double almost what it was just 1 year ago. Now, of course, the people that are getting squeezed the most by these new and used car prices are not the rich people, and that is seen here. American Express reported blowout earnings because the people that use American Express are generally richer and have higher credit scores than people that buy subprime cars with subprime loans. And so at the other end of the spectrum is the Discover card, which are usually poorer people with worse credit scores. And they are now forecasting their charge off rate going from 1.82% in 2022 to 3.5 to 3.9% in 2023 because a lot of people are using credit to pay for food and bills that have increased because of inflation. And so that's part of the reason people cannot afford to keep paying their high priced car loans. And so here's a chart of borrowers that are at least 60 days late on their car payments. And you see that that bottomed out after all the stimulus, after the pandemic. People got all this money and they were paying their car notes. But now we are right back up to the level it was creeping up right before the pandemic here. But it is still higher now than the peak of the great financial crisis levels right here. So they say because of that, repossessions are soaring and the truck repossession companies are having a hard time getting workers. That's a booming business. If you are looking for a job, look into repossessing cars. So they talk about the case of this 21-year-old Kobe Hatch in Chicago who walked outside in December and couldn't find his 2013 Dodge Journey. He immediately knew it had been repossessed because he hasn't made car payments in months. And because of that, he couldn't do his job as a delivery driver for Amazon, and so he got fired. And just as a tip, generally, it's not a good idea to use your own car, whether it's for Amazon or Uber Eats, because you're funding the wear and tear and depreciation on your car. But here's the shocking part. It says for Hatch, who is subprime, the total monthly bill for his car reached about $1,000, including the cost of insurance, thanks to a whopping 26% interest rate. And if he wants the car back, he has to pay an $1,100 repossession fee. Now, guys, let's think about how crazy that number is. 26% yearly interest for a used 2013 Dodge car. And if you back out the math, you can figure out what he paid for this 2013 Dodge. So it says his payments are $1,000, including insurance. And that's one other bad thing of buying a car through a dealer with a loan. You have to have full coverage because the bank won't lend you the money unless the car is fully covered for fire, theft, and all of that. Whereas if you buy a car for cash, you can just get the cheapest liability insurance. So from that $1,000 a month payment, we can figure out what the car cost. Let's assume that out of that $1,000, $200 a month is for insurance and the other $800 is to pay the loan. Assuming the rate is 60 months for the loan term and the interest rate is 26%, down payment doesn't matter. It would just add to the initial price of the car. But let's just assume he put nothing down and no trade-in. He's in Chicago, Illinois, 7%. But when you calculate that, the loan amount for the amount he's paying per month would be $26,700. So he would pay $48,000 over the life of the loan. $21,000 of that would be interest. Now let's assume it's not an $800 car payment. He's young. Maybe his insurance is expensive because it has to be full coverage. So let's say 400 out of that 1,000 is for the insurance and the other 600 is for the car payment. Everything else is equal. So the loan amount would be $20,000. And so the total payments would be $36,000 with about $16,000 of that as interest for a car that is not worth a lot of money. Let's go see what a car like that is really worth. So this guy made a lot of mistakes in his purchase and basically set himself up for failure in the future. And so let's see what a car like that actually costs if you were to buy it for straight cash on the open market. So looking here on cars.com, you see the cheapest 2013 Dodge Journey is like $6,000 with 147,000 miles, which is kind of a lot, but not really for a 10-year-old car. It's probably similar to the mileage that he bought his for. But here is one for $7,000 with 100,000 miles. So for $7,000, that is like 7 months worth of his $1,000 a month payment. So if he would have just saved up for a few months, he could have bought this car outright cash, got liability insurance only, and still been driving this possibly. Now, I wouldn't recommend the Dodge Journey because they're junky cars, but you get the idea. Now, even people with lower car payments are having problems paying for their car. This 25-year-old is paying or was paying $556 for his 2021 Subaru WRX. But since he couldn't pay, the car got repossessed, and his tow fee will cost him $1,600 plus back payments. And it says he's trying to save up for another car, but it will likely take a while. He should have done that in the first place instead of buying a brand new car at 25 years old if you don't have a lot of money put away for a rainy day. Okay, well, he's just young and dumb, right? And he learned his lesson, and it was a lesson learned, and he won't make it anymore. But there are people that are even older that are still having problems. This woman is 53 years old, and she splits the monthly bill for the car, a 2013 Honda Fit, which is about $178 with her roommate. But then the roommate lost his job. And since the price of groceries and everyday items are increasing, there wasn't enough to make the car payment. So they say this financial squeeze has been particularly difficult for lower income consumers looking for budget vehicles. Because in the past, they would have bought a car for $7,000 to $15,000, but now they're having to spend $20,000 to $25,000 for the same type of vehicle. So the subprime lenders like Ally Financial are reporting that they are expecting delinquencies to increase to as much as 3.8% compared to 3.1% in 2019, but that was in October. Their new estimate is most likely going to be a lot higher than because Capital One, who just released their fourth quarter 2022 earnings, reported net income of 1.2 billion, which is half of what it was just a year ago. And so Capital One is big in the subprime lending of car loans. So they increased their provision for credit losses by 747 million up to 2.4 billion, which is up from just 1.4 billion a year ago. So they're expecting their losses to increase for these car loans. And so this Twitter guy, car dealership guy, which claims to be an anonymous auto industry CEO, says that the net charge-off rate for auto loans was 1.7%, up from 0.6% last year, and auto loan originations were at 6.6 billion, down 20% year over year. So lenders are tightening up their standards because they're starting to see bigger and bigger losses. And so he says, what I see on the dealership floor, I believe that Capital One has taken the most drastic turn in tightening the credit compared to Ally, Santander, and others. Our volume with Capital One is down 50% quarter to quarter. So they're like, we're getting a lot of people not paying their loans. We're going to ease back on making new loans right now. So the repo business is booming. They say these repossessions are occurring on people who could afford that $500 or $600 a month payment 2 years ago, but now everything else in their life is more expensive. That's where we're starting to see the repossessions happen because it's just everything else starting to pin you down. So he says he can't find enough repo men to meet the demand or space to hold all the cars his company has been tasked with repossessing. So he says right now it's really the perfect storm. Over the last 2 years, vehicle prices were inflated because there was no new car supply. People were still buying like crazy because they had a lot of stay-at-home cash. They had inflated credit scores, so it was like a recipe for disaster. Guys, everybody's situation is different and everybody makes choices on what they spend their money on. But a lot of the situations that people find themselves in could be avoided. In the case of the guy with the 26% interest rate, he never should have taken that loan in the first place and should have saved up some money and bought just a junker kind of car just to get him from point A to point B for cash, where he doesn't have the extra insurance and high interest rate. Just because you pay $1,000 a month for your auto payment doesn't mean you're getting $1,000 in value. Most of that payment is going to the bank on interest and to the car dealer for the inflated price that I'm sure they sold him the car for because maybe he was the only one that would lend him the money. And so they jack up the price of the car and add on the high interest rate. And so these loans are designed to fail in a few years, but it doesn't matter because they get all their money out of this customer within a few months. And so it doesn't just go for things like cars, it goes for everyday things like people spending $17 for avocado toast that cost $2 to make, or people who think nothing of buying a $7 Big Mac meal from McDonald's, but getting it delivered from Uber Eats and it ends up costing them $25, $30 that they just put on their credit card and carry a balance over the next month while they're paying 20% interest. If you want to avoid financial stress in your life, make it a point never to pay interest on anything that doesn't appreciate in value. And so that would only be a house or maybe a business. Like George Carlin said, we buy things we don't need with money we don't have to impress people we don't like. So think about that the next time you want to burden yourself with debt to buy something just to impress your neighbor who is most likely in as much or more debt than you are.